I still think you're going to several $100s on silver. It
Right.
wouldn't even shock me if you went to 500. Now that sounds ludicrous. Here's the logic behind that.
Could you see silver dropping or testing 50?
Where would you have bought it? Did you buy, if you bought silver in the 30s and 40s, okay, are you doing bad? Okay, well, yeah, if you bought it at 110, maybe you're hurting. You got to regard this pullback as an opportunity because I see nothing that argues that we're at the top. And I think it is a mistake to regard silver as just industrial. I think
Yeah.
silver is a surfer and he's surfing on two waves. The one everybody knows, that's the supply demand deficit. The world needs solar panels, especially the undeveloped world. They want to have power plants in every city. And China is satisfying that demand by producing like 80% of the world's solar panels. Voltaic cells have silver in them. And then the AI expansion we're all hearing about.
Yeah.
Don't be shocked about what comes in the next, let's say by summer. Even gold at 8,500, do a 3% of that. You're talking, 2 to 300 silver. If it went to 6%, like 1980, when it was 6.5% the price of gold. I don't think we've got a top, and I think this is just the jiggle in the middle.
You've talked about you've talked about prices for silver in the 300 to 500 range, which most people think is ridiculous. But as Alistair says, most analysts think that this is it. They see this sort of
That's
a
fine. Yeah. Yeah.
and it's all over.
Hmm.
Said it matters why. Why did it go up in the first place? And of course, there's no understanding of gold and silver as money to start with. So if you look at it in terms of that, if you really measure everything in terms of ounces of gold rather than in dollars,
Hmm.
I think you'd
Hmm.
have a better picture of what the world is really like. And of course, most people we're not trained to think that way, and people aren't thinking that way. So yeah, I mean, if you think the dollar is the holy grail and that's the currency you got to live by, then and that's if you really buy the idea that it's solid, I don't know how you could do that, but some do, I guess, and that's all you have to go by. So yeah, it's understandable why people can't see what you and I see, what Alistair sees, and other
Yeah.
people understand what money really is.
The real shock here isn't the $300 to $500 silver idea, it's how deeply investors are conditioned to price everything through a weakening dollar lens. As Michael Oliver frames it, measuring wealth in ounces instead of currency exposes how distorted normal price thinking has become, especially after decades of monetary expansion. Since 2008, the US dollar supply has expanded multiples faster than real output, yet most portfolios still benchmark returns in nominal terms. That mental shortcut hides loss of purchasing power and makes long-term hard asset moves look irrational. For everyday investors, this isn't about hype. It's about realizing the measuring stick itself is bending. And what Michael Oliver hints at next challenges how most people define a market top.
Um, could you see silver dropping or testing 50?
No, I don't. It doesn't make sense to me. No.
Yeah,
Uh, the I'd be looking right now. Our daily stuff is overdone. Okay, we know that daily movement, short term,
yeah,
and even the weekly says, "Hey, yeah, look for a low real soon." So if somebody had not invested in silver or gold up to this point,
yeah,
for whatever reason, uh, and is thinking about it. Of course, now they think, well, see, I'm glad I didn't. Well, of course, where would you have bought it? Did you buy, if you bought silver in the 30s and 40s, okay, are you doing bad? Okay, well, yeah, if you bought it at 110, maybe you're hurting. Uh, but you got to regard this pullback as an opportunity because I see nothing that argues that we're at the top. Now, let me give you an example. The MSA is very flexible on long-term assessment. Yes, I understand the fundamentals of gold and silver.
yeah,
Philosophically, I've long understood that.
yep,
And ultimately, they win.
What sounds like confidence here is actually risk framing, not prediction. Michael Oliver is pointing out that short-term technical exhaustion doesn't invalidate long-term structural trends, a distinction many investors ignore when prices pull back. Historically, major precious metal bull markets have endured 20 to 30% corrections without breaking trend, including gold's 2006 and 2010 pauses. The danger for portfolios isn't volatility, it's waiting for perfect entry points that never return. This mindset shift matters for retirees and long-term savers who confuse timing risk with valuation risk. What Michael Oliver underscores next is why corrections often punish late skeptics more than early believers.
They
Hmm.
always hold value, especially gold, versus the decay in the money unit.
Sure.
In other words, you look at an M2 chart and it's parabolic. That reflects the decay in the money unit because of the quantities exploding. And gold reflects that by continuing to hold value versus that thing. Whereas even the stock market doesn't hold its value versus the decay in the dollar. In fact,
Hmm.
if you go back to 2000 the
Yeah,
dot-com pop, 1500 S&P, and measure where it is now, factor in the decay in the money, it has not kept up with it.
exactly. I believe gold
Yeah,
has outperformed the S&P since.
gold has vastly outperformed during that
Yeah.
25 years. So,
You-
yeah, there's ups and downs, but it continues to hold. Okay, people forget that. They don't notice that.
Yeah.
Silver has vastly been capped off, something we pointed out, in a
Yep.
50-year range. And you say, well, okay, well, copper, we did studies of this, copper and lead, two base metals.
Yep.
You go back to this 1970s, 80s, 90s, 2000 till 2005, copper was in a rectangular range, just like silver.
Mm-hmm.
$50 range to $4. It was 50 cents to a buck 50 a pound. Finally, in late 2005, copper punched up above the top of that range,
Mm-hmm.
incredibly, and began an explosion.
The quiet truth here is that headline equity gains often mask real purchasing power losses. As Michael Oliver notes, when adjusted for M2 expansion, the S&P 500 has struggled to preserve value since 2000, while gold has materially outperformed over the same 25-year span. That's rarely mentioned on financial TV because it undercuts the stocks always win narrative. The copper comparison is especially revealing. Decades of range-bound pricing didn't signal weakness. It signaled suppressed discovery. For investors, the risk isn't missing upside, it's trusting benchmarks that ignore currency decay. And what Michael Oliver highlights next raises uncomfortable questions about why silver hasn't been allowed to follow the same path.
It quadrupled in price on its own.
Yeah.
Wasn't with gold and silver, wasn't with other base metals. Quadrupled in price in a matter of several quarters,
Mm-hmm.
and then lived in a new reality between $2.50 to $4.50 as opposed to 50 cents to a buck 50. But it did it so suddenly. Then you look at lead. It lived in a range similar to copper's, but it didn't break out till 2007, and it quadrupled in a matter of several quarters
Oh,
and lived in a new. How come silver hasn't done that?
yeah.
If silver were to match that, you'd be $300, $400. And if silver were to go up to price levels that reflect the decay in the money unit versus where it was in 1980 or even 2011, it'd be several hundred to $500.
Yeah. That's where you
And
come up with
yeah,
that
in
number.
terms of compensating for this underprice in relation to
Right.
the money unit, okay,
Right.
and catch up to gold in value.
Mhm.
So no, I don't think this is a top. This is a buying opportunity, especially if you've not been in. And
Mm-hmm.
look for the turn.
This is where historical symmetry collides with modern disbelief. Michael Oliver is drawing on precedent. Copper and lead didn't drift higher. They violently repriced once long-term suppression ended, each quadrupling within quarters. Adjusted for dollar decay, silver's failure to do the same is the anomaly, not the $300 to $500 projection. Since 1980, the dollar has lost over 70% of its purchasing power, yet silver trades far below inflation-adjusted highs. For diversified portfolios, this isn't a momentum bet. It's exposure to mean reversion after decades of distortion. And what Michael Oliver implies next is why these repricings rarely give polite entry signals.
Yeah, but as you
That's what
say,
we'll be focused on.
most people won't recognize that buying opportunity because they've been trained to think in terms of dollars.
Yeah,
Um, I talked to Frank Holmes yesterday, and his view on silver's strength was that it's coming primarily because of this massive industrial use and military use application high-tech applications and so forth.
Hmm. Hmm.
And Frank doesn't see it so much as a monetary thing, but I don't know what your thoughts are.
I do. It's
You're
still
a
money. It's,
you're a technical
yeah,
analyst, and so
yeah,
you let the numbers talk to you, and then on that basis, maybe try to figure out why. But it's not important. Primarily, you just want
yeah.
numbers to tell you what it is, not philosophically why it is where it is. But
Yeah, but it's numbers when you compare it to its metal that it's been in linked with for centuries, for thousands of years, is gold. I'm
yeah,
sorry, silver is money. In
yeah,
fact, it's been legal money, and I think India's even thinking about it. Okay,
yeah.
so you
And
get into,
China used silver as their monetary
yeah, and
way in
gold
the
as
past.
well. Yeah.
The real disconnect here isn't silver's use case. It's how investors have been trained to ignore its monetary history. In the first few minutes, Michael Oliver makes a subtle but critical point. Price doesn't care about philosophy. It responds to pressure, and silver's pressure profile looks monetary, whether Wall Street admits it or not. Central banks now hold over 35,000 metric tons of gold, yet silver remains absent from balance sheets despite thousands of years as legal tender. That absence distorts perception. When markets price silver only as an industrial input, they ignore its role as currency insurance, a mistake retail investors pay for. What Michael Oliver hints at next reframes that mispricing entirely.
We get into a crisis in the West. Now we're in one in Japan.
Yeah.
They've got a situation where a government bond market of a major U.S. linked power, call it a Western power, even though it's in the East, it's part of the West, uh, is in collapse mode. You can't have that. You
Yeah.
can have mortgages collapse like 7 to 9. Okay, they'll print money to cover that. But when their own government debt instrument is in jeopardy, as ours is,
Yeah.
ours is already collapsed from 2020 to 2022 from a price of 190 on T-bonds to
Hmm.
117. Where is it now, 3 years later? 115. It can't get off the floor.
Yeah.
It can't, it's tried multiple 3 waves of rally, not been able to get off. If you slip about 3 points below where you are now, you're going to have another plunge. You can't have that because when government debt is suddenly highly questionable.
This is the part most headlines won't touch. Government bonds failing is not a normal recession signal. As Michael Oliver has warned, a 40% collapse in long-duration treasuries from 2020 to 2022 isn't volatility, it's structural damage. Japan's bond market cracking matters because sovereign debt underpins currencies, pensions, and banking collateral worldwide. When yields rise because buyers vanish, money printing becomes the only response, and that erodes trust fast. Investors still calling bonds risk-free are anchored to outdated assumptions. If this floor breaks, Michael Oliver's next insight explains why metals react first.
And I think it is a mistake to regard silver as just industrial. I think
Yeah.
silver is a surfer, and he's surfing on 2 waves. The one everybody knows, that's the supply-demand deficit. That's
Right.
now a well-known fact.
Yeah.
And
Oh,
it's
yeah.
persistent, and it's not getting better. Okay. And it's
Yeah.
not going away. The world needs solar panels, especially the undeveloped world, the lesser developed world, because they don't have power plants in every city. And China is satisfying that demand by producing like 80% of the world's solar panels.
Solar panels. Yeah.
And they need the voltaic cells have silver in them. And then the AI expansion we're all hearing about and the
Yeah.
computer, that silver is essential in that.
Yeah.
Uh,
So it's both an
Pervasive.
industrial and a monetary metal,
Yeah.
and that's
And yeah, nobody's
and
talking
yet,
about the monetary
well,
aspect.
it's been kept at bay. I mean, we haven't had Andy Schechtman argues that we haven't had price discovery in gold or silver, especially silver, from as you pointed out, essentially. What doesn't
Well,
make any
copper
sense.
did. Copper did in 2006,
Hmm.
fourfold. Lead did in 2007. Gold, look at it.
Calling silver just industrial ignores how rare dual demand assets behave under stress. As Michael Oliver notes early here, persistent supply deficits combined with monetary pressure create nonlinear price responses. China producing roughly 80% of global solar panels locks in structural silver demand, while AI infrastructure quietly compounds it. Yet silver hasn't seen true price discovery, unlike copper's fourfold run in 2006 or gold's historic breakouts. That lag isn't bearish, it's unresolved tension. Portfolios underweight silver are effectively betting this imbalance never snaps. What Michael Oliver says next challenges that assumption directly.
1980 high, 2011 high, vastly above it. And by the way, the two surges there, I've said this probably before on your show, 76 to 80, that bull market, eightfold move.
Mm-hmm.
2001 to 2011, eightfold move from bear low to bull high. Where was our bear low? 1,050. What's eightfold? 8,500.
Yeah.
Did we get there? No. We haven't even matched the multiple gains that gold has seen twice before in routine bull markets.
Yeah.
And yet it's overdone? Oh, I think not.
And
Okay.
and I know you don't think this is anything like routine, but I have to ask you, Michael, what's your hunch on silver? Silver has been such an anomaly, as you point out. These other metals have had runs, but silver has been
Yeah, it
kept at
it
bay.
got it achieved nice enough levels for me to smile to say, oh, that was a midpoint high in time clock, not on
Huh?
price. Well, you went from we got bullish at 35, it broke out at 50, and next thing you know, you're 120. Okay, so there's a high. Okay, let's assume that's your midpoint high,
Yeah.
not in price, but in the on the clock or so.
The word overdone collapses when you compare silver to gold's historical math. Michael Oliver points out that gold delivered two clean eightfold bull markets, yet silver hasn't even matched one despite similar macro backdrops. If silver's move to 120 was a midpoint in time, not price, then valuation models many investors rely on are structurally flawed. Markets don't top on symmetry. They top on exhaustion, and silver hasn't shown it. Positioning data still shows institutions underexposed. And what Michael Oliver outlines next reframes where the real upside risk may be hiding.
So maybe get 3 or 4 months on the other side once you break out above it. Uh, in both the 79 and the 2011 surges, what came on the other side was vastly more than what was on the first side of the
Yeah.
swing. Uh, I still think you're going to several $100s on silver. It
Right.
wouldn't even shock me if you went to 500. Now that sounds ludicrous. Here's the logic behind that.
Right.
Silver range in arithmetic price was $4 to 50 for the last 50 years.
Uh-huh.
That's a tenfold move. Okay.
Right.
But if you do an arithmetic chart and you're an orthodox price guy, you
Mm-hmm.
draw a rectangle and you take the rectangle distance and you add it to 50.
Mm-hmm.
Okay. If you take $4 to 50, you end up with something like mid 90s would be the swing objective,
Uh-huh.
$45 swing. Well, look what happened several weeks ago. We stalled for a couple weeks in that 93 to 95 zone, where those guys were no doubt taking profits,
Uh-huh.
thinking, oh, we reached the swing objective. Okay.
Mm-hmm.
You exploded through that and proved no, wasn't the swing objective. Okay. You went to 121, nothing to do. If you take the logarithmic scale, ratio price scale of silver, and you go from $4 to 50.
Most investors miss this because they rely on neat arithmetic targets while ignoring how real bull markets actually expand. As Michael Oliver has pointed out before, silver's prior breakouts didn't peak where technicians expected. They accelerated once those levels were cleared. The stall around 93 to 95 looked complete on an arithmetic chart, yet price surged to 121, signaling momentum, not exhaustion. Historically, both 1979 and 2011 delivered far larger moves after the breakout than before it, which challenges the idea that silver is already extended. For portfolios, this matters because positioning too conservatively after a breakout can mean missing the most profitable phase of the cycle. What comes next forces investors to rethink where upside risk truly lies.
Let's call it 5 to 50.
Yeah.
That's a tenfold dimension move from bear low to bull high.
Right.
Tenfold above 50 is what? When you take a logarithmic scale and take the
Yeah.
thickness of the range, and it says 500.
500. Yeah.
If you go back to 1980 high in silver and factor in the dollar's decay, you'll come up with something like that too.
Mm-hmm. No,
So it wouldn't shock me. And also, when markets get overly done one way or the other, silver overdone on the downside,
overdoes. Yeah.
it
Either way.
overshoots. Maybe it goes to a new reality, but it goes in excess and
Right.
then pulls back to
Yeah.
the new reality. So
Yeah.
don't be shocked about what comes on the next, let's say by summer.
And a similar logic, I think, has gotten you to 800, 850 or so. I mean, 8,000 or so in gold, right?
Well, that's not even a target for us. That's simply saying
That's
That's
just
what it
getting
did
back to where
twice
we were
before.
before.
Yeah. I mean, we've done it twice before under conditions that were hardly as fundamentally earthquake
Yeah,
as
as
what
it is now.
is driving gold now.
Yeah, yeah,
So I don't even expect it to stop there, but we haven't even gotten to the ratio moves of those bull markets.
The numbers sound extreme only because investors anchor to nominal prices instead of real historical context. As Michael Oliver notes, when you apply logarithmic analysis and adjust for dollar decay, today's silver projections simply mirror past cycles rather than inventing new extremes. Markets that are suppressed for years rarely revert gently. They overshoot, then normalize at much higher levels. Gold's prior eightfold advances occurred without today's debt, deficit, and liquidity stress, which raises uncomfortable questions about how safe current valuations really are. Ignoring these dynamics leaves portfolios exposed to purchasing power erosion rather than volatility. The next phase challenges assumptions about what prices are supposed to look like.
yeah. And then if you get to 3% or higher in silver, you can see silver going to
Oh, well,
extremely high numbers. So
yeah, even gold at 8,500, do a 3% of that, you're talking, 200 to 300 silver,
yeah, right.
And if it went to 6% like it was in 2000, back in 1980, when it was 6.5% the price of gold.
Yeah.
Wow. So,
Yeah, I
no, I don't think we've got a top, and I think this is just the jiggle in the middle. And
jiggle in the middle. Okay,
mhm,
jiggle in the middle. That's a good
mhm.
title for the.
Okay.
But yeah, you're very fond of looking at spreads, and I know you like to look at the spreads, like the shares of gold to gold to the bullion,
Mhm,
silver shares to the silver
mhm.
bullion. What's that looking like now? I mean, they're still very
Yeah,
suppressed. Shares are, right? So
yeah.
see an awful lot of upside, even if we don't get the kind of breakout you're talking about. If silver and gold stays where it is now, I don't think the market is recognizing, hasn't
No,
priced in
no,
yet.
no, no,
No.
no. They haven't. The miners are vastly undervalued.
The real signal here isn't price targets, it's the ratio behavior investors keep overlooking. As Michael Oliver emphasizes, silver's historical relationship to gold has swung between 3% and over 6%, levels far above where it sits today. Even a partial normalization implies substantially higher silver prices without requiring gold to surge further. Meanwhile, mining equities lag badly behind bullion, signaling valuation compression rather than speculative excess. For long-term investors, this disconnect means risk may lie more in underexposure than in chasing momentum. What follows reframes miners not as leverage plays, but as mispriced assets.
We measure XAU index because it goes back to the 1980s, and we can go back far in measuring its relationship to gold. It's gold and silver miners
Hmm.
versus gold. And we're now back below 8%, meaning divide XAU into gold. We were up around above about 8.6% earlier this month.
Hmm.
There is a range on the spread relationship between XAU and gold
Hmm.
each month, plotted what percent is XAU to gold between 5 and 8+% for 11 years. We
Yeah.
probed up over the 8% a couple times, did this month as well.
Uh-huh.
If you get a month that closes over the top of that range, like above 8.6%, okay, we're
Uh-huh.
not there right now. We've tried. I think we'll get there. There is nothing on that chart. You go back to the 1980s and you'll see that XAU on average for decades was 25% the price of
Wow.
gold on
Wow.
average, so it above and below there,
Yeah.
with lows on that spread relationship over decades at 17 to 18%.
Yeah.
You collapsed to 4% by 2015 in that bear market. The spread collapsed, meaning the
Yeah.
miners devalued the gold. And they've lived with highs about 8%. If you broke out of that spread relationship and shot up even just to the bottom
Hmm.
of that prior multi-decade relationship,
Strange. Yeah.
you'd more than double the value of gold miners and silver miners
Right.
to gold, just
Yeah.
getting there.
Yeah.
Wow. I
Yeah.
expect it to happen.
Yeah, there's so much, and I think in part because there's a lot of people got rich really fast in the high tech sector, and it's just, I mean, there's this little company called Hydrograph Clean Power that I follow, and
Mhm, mhm.
Michael, I made more money in 3 or 4 months than I did in 30 years in the mining sector.
Yeah.
That's
Yeah.
because I took a very aggressive
Yeah.
position in all of that. But not what I'm
You've been
saying
on
is,
top of that one. You call that and we're on top of it.
well,
Congratulations. Yeah. Yeah.
This is a valuation story hiding in plain sight, not a speculative pitch about metal prices. As Michael Oliver has highlighted, the XAU to gold ratio spent decades averaging near 25%. Yet today it struggles below 8%, a level associated with deep bear market psychology. Even a move back to the lower end of historical norms would imply a doubling in relative minor valuations without heroic assumptions. Capital has chased tech momentum while starving resource equities, creating an imbalance rather than efficiency. For diversified portfolios, that neglect represents asymmetric opportunity rather than comfort.